Outgoing family, yes. Been a minute. Kinda ill, so then there was that. Anyways, as a undergrad student, I literally just finished a degree in banking and finance and econ. I believe I know enough about this company, seeing that one pass it every day to and from school, especially in the late night hours. So with that said, we'll be looking at one trade student living, how they make money, and of course why they're coming to the market. So with that said, make sure you like, share, comment, subscribe to a friend, and let's begin. Alright, so what is one trade student living? One trade student living is really just a real estate company that facilitates housing solutions for students. It was founded on August 15, 2014 and has housing facilities across the country, including Kingston, Montego Bay, and Mandeville. With one of their goals recently being completed, which essentially was to just create housing solutions for students at university at the West Indies. Alright, so the products and services that they provide essentially is to just ensure that they operate and maintain the housing solutions that they established. And basically these are fully furnished rooms or dorms that college and university students can use through their tenure at the university and so on. Alright, so before we go in further, I'll just give you a summary of the offer because they are actually coming to the market for APO. So the summary of the offer essentially is 513,972,784 new ordinary shares with the possibility to upsize to an additional 256 million shares. 195 million of those new ordinary shares are for the general public, and the 318 new shares are reserved for existing shareholders, members, teams, and 318 million of those ordinary shares are reserved for shareholders, one trade to living team members, and strategic partners. For the existing shareholders, they'll get the shares at $4.05, and for non-reserved person, they get $4.40. Essentially, the persons that do have the share already, they're going to get it at like a 35-cent premium. Of course, GK is the lead broker, but you know you have other brokers you can buy it through, and it closes on October 6th, which is soon. So alright, so essentially the use of funds can be broken down into three main parts. The first and most important one always transaction cost. Transaction cost is basically the estimate amount of money they think they're going to have to spend in order to get the IPO running or get it fully function. So transaction cost. The other thing is they're going debt reduction, which I think is probably one of the most crucial parts. And when we go into the financials, I'll explain that more as to why reducing the debt can be beneficial and can probably be better, like give dividends at the end of the year. And the last thing is they said they have some other investment opportunities. However, I do think I have an idea as to what they're going to do the money with, but just a hunch. But so I already know that they were established on August 15, 2014. Alright, that's the company. They are a subsidiary, which is One Tree Restoration, which essentially under the concession agreement that they had with the university was essentially just restore back the buildings at UA. Basically restore the buildings and build all about the restoration aspect of it was to just restore the buildings that were there that students normally dorm at. So there was that. So basically on a concession agreement, one trade student living would build 1,584 units in 3 phases over 4 years for the university for them to occupy basically. Alright, so what will happen now is that after they have built unit, they will just continue collecting rent at that time, so collect rent for 30 years essentially. 30 years, and they had the possibility to extend it to 65 years. And this was all dependent on whether or not one trade student living could retain a 15% internal rate of return. Alright, so basically what made one trade student living unique is that 90% of the revenue is secured by the university. Alright, so at any given point, 51 out of the 52 weeks in the year, you will guarantee 90% occupancy of all the buildings that they're coloring from, essentially. So if nobody not there, then you have to go for that, and you'll see that there are a lot of receivables in COVID. And even though you will say, oh, they understand this and that related, the truth is, if everybody did there them yard same way during COVID, they would have just essentially have to pay or at least have debt with one trade student living ongoing, and that is why them kind of push it and gradually push it as they get the opportunity to go back face to face, gone, cause essentially was bleeding money. So that's why when you looked at one trade student living financials, they had a lot of receivables. Anyways, currently they're not necessarily at the 1500 mark, but as of right now, they operate 1,464 rooms on the campus. So yeah. And in 2022, they readjusted the concession agreement, and it kind of understandable because COVID just take away 3 years of them things. Hey, so essentially they opted to get an extension, and it was, it went through. So yeah, other day I was watching Khalila's show and someone mentioned something. I'm going to play it right here.
So this brings me to a question from one of our viewers, Shelly-Ann Parkinson. Shelly-Ann says there was IPO money plus other borrowed money plus no dividends. I don't see what they did with all that money. They paid one dividend in 2023 because they knew an APO was coming. Can you respond to that, Cranston?
Right. It's a very good comment and observation, Shelly-Ann. 138 is still a very young company in a growth phase. We're just about 8 years old. A lot of the debt that we raised, as a matter of fact, all the debt that we raised went into the construction phase of the business. And because we were so locked up in debt, it restricted us a lot from paying dividends. And then in say 2019, thereabout, when we begin to turn around the company and begin to record profits on our bottom line, then came COVID-19.
Alright, so bear with me. Understand, and sometimes I'm not picking up for the company or anything, but understand, in 2014 they were established. 2015 they started doing restoration thing, and over the 4-year period, so 2015 to 2019, basically all they've been doing is building out the complex. So the money they generated from the IPO was building out the complex. So yeah, and in 2019 come and COVID came, and COVID lasted 19. I literally went to call it through COVID. So 2019, 2020, 21, 22, give or 22, give or take. You see me? So essentially at 2023, them really have like a full year operation, which was when they paid dividends. And yeah, it kind of seems sus. So I want to pay dividends because I come to the market. But you have to think about it, like if you use all your resources to pay and to build the buildings, and then when you're supposed to start expecting money for rolling, COVID come, you kind of have cash because, well, anything can happen in a COVID, and remember say it's a public listed company, them offer them auditors money and them something there same way, and operations and maintenance, so them never could have paid the money at that point. Here's that. I'm not vouch for the company. I'm just saying if you just take a minute to like kind of understand what is going on, I feel like the growth going to start now because all of the revenue them are coming now because, well, COVID done, them are calling money now, and them start try to reap them reward back. So I say if they paid one dividend this year and then them the pay them next year, then you can say sus. But if you see them pay and them pay next year, you can know say alright, and the COVID will them down and them books there now, so them good. So them a year or so, see what them do, and then you can make like a judgment from there. So but it's just kind of a way for like kind of think about things. And while we're on topic, there's a few highlights. One, they're currently at 93% occupancy, meaning say they are covering their bare minimum and then some. So there is that, which is good. The aim with this APO is restructuring debt so them can have more money to either use or to actually just give shareholders. So there is that. We're gonna financials explain more of that. Three, them did actually pay them first dividend, which kind of help shareholders for like feel like they're not sleeping on a dead company. So there is that. Speaking of dividend, so within the next say 1 to 5 years or so, because they said the short to medium term can be 10 years. Their aim is to essentially pay out 90% of the distributable net income to shareholders on a semi-annual basis, means they get paid dividend twice. Can be good if it's a real estate company and it is operating like a probably REIT in a way, but we saw but yeah, so essentially we'll go to the financials and then yeah, regular style. Alright for me. So not really do much on the financials. There was just a few key points personally. Me did want like kinda understand before I gave any say on it. So going to talk about the financials, of course. We're going to talk about relative valuation, and then I did spend a little extra time on the debt aspect of it. First thing first that I totally forgot to talk about essentially is the fact you guys, there's three main brokers. You have GK, you have JMMB, so GK platform, JMMB, and you have GN for managers. They have a new platform called Bloom. Those are the main brokers. To the financials, really, there was some stuff I was looking for, but it seemed like them left it out, and that's fine. No reverse calculated, so I got what I wanted regardless. Without going too in depth in anything, we're just going to look at the DuPont, and from here, so you can see it's a real estate company. Yeah, I already know SEO is leverage them are going to use predominantly, which is why the leverage line right here so is the highest compared to everything else. But like understand fully what is being said right here, so you can just go in further. So the abridged version, which should essentially encompass all of them have. So you could just use this sheet that they gave essentially and just figure out everything. Alright, so do more analysis. You can see that then basically the profit margins, them just there start out say oh, nothing too great now go on. Profit margin slim, it has gradually increased year over year. It kind of fluctuates a little bit in 2021, 2022, but profit margin of 26% is decent. It's pretty good actually. Return on assets, meaning all assets them have, which the concession agreement only give them like temporary ownership to collect revenue from it for 30 years and best case scenario 65 years, after which will return the properties over to you. So there's that. So as you can see, it fluctuates basically to 8%, 9%, 12%, 8%, 12% no return on assets. So you really not gonna make this as one profit margin. It's like you sublease in a place. Basically, you don't own it, but you collect money for it. Technically, even though you build it, because that was a whole business model. Anyways, and as you can see, leverage, which did high, and then when you were more money, 2020 you see go up more, and then go. It has been trickling down. And I'm going to show you on the financials. This aspect of it essentially is the 3 years. Basically 2020, 2021, 2022. So as you can see, 4.206 and go up a little bit and then it dropped. 3.8 is what they were at here in 2022. But this as we say the quarterly, the Q3, I think this is Q3. Anyway, so Q3 is essentially amount of $3.5 billion. All of these numbers is supposed to add the 00 at the end, but just to cut it kind of short, that. Yeah, they have been paying it down little, and then them end up give us dividends. But we'll talk more about that. Alright, so now to the relative valuation. And I already knew that this would be skewed because, well, real estate, the highly leveraged and is an inflated market. Anyways, as relative valuation for it, as you can see, the industry average is 20.09, and this is a weighted average. So there's that. The trailing EPS for 1 tree student living is 8.04, 0.84, sorry. And then the industry average for the price to book is basically 0.75. Exodus run up. Book value per share is $11.50. So when you do the calculations, you would see that these fair values are really high, really high. So as the fair value for it would be $12.75. But say it currently trade at $4.34. So as we say, relative valuation encompasses the aggregate, and if everything in the market inflated, then essentially you get a skewed calculation. For the debt note, which I just kind of delved in it a bit more than should, but it's cool regardless. The ordinary shares that they're offering, alright, so the ordinary shares that they're offering is basically 513 million shares, alright, and then the potential for the upsize is 256 million shares as well. Of course, 195 million of those shares are non-reserve, mean like the public can get some and they can get it at $4.40, while the reserve shares, for key strategic partners, existing shareholders, employees at the companies can get that $4.05. Alright, so all of this would essentially be a cash value of, well, for the non-reserve share will be 806 million, but for reserve will be $1.2 billion, essentially coming to a total of $2.1 billion. If they are lucky and they do get upsized, they'll get an additional $1,085,000,000, and then that would then leave them with a gross total of $3,235,000,000, and so on. Alright, so there is that. When they are currently at 414,500,000 shares at a market cap of 721 million. However, if they do get all they want, basically, the shares will increase to 928,472,784 ordinary shares, and then that would carry them to a total of 2.8 billion shares at that day. And I would value them at $2.8 billion. Alright, so this is where I got a little bit indulged with. Before we go to that, everybody want to talk about dividends, but let's talk about them debt, because the use of proceeds, as you can see right here, so this is assuming them get the first batch of money, and this is assuming they get the upside. This is what they assume. This is all for the document. So you can see is 1.5 million in for reduced debt, and then other investment will be 547 million, and then the transaction cost will be 102,500,000 mash, which is a lot. Transaction cost healthy. Anyways, if they do get upsized, then it would be 2 billion to reduce debt, 1,085,000,000 to do other investment opportunities, and 140 million for transaction costs. However, as you can see, is that this is the first part. So if the offer is standard, they don't get upsized, then this would be the percentage. So basically 70% of the APO is going towards just paying off debt, and then the rest, you can see 25% for opportunities and basically 5% for transaction costs. Roughly same, closer to 4% of transaction costs, and then investment opportunities would increase to 33% of the overall fund raised, and then 62% would be to reduce debt. And if they do get what they want and they do hold whatever they say in the document, it might pay off for shareholders. As stated earlier, they have currently 414 million shares, 500,000 million shares. All right, essentially you roughly double the amount, well, more than double the amount of shares that going be there. So essentially shareholders would like get diluted now. However, as I say, if they do mention, so basically we're saying right here, so group reported non-current liabilities of 4.02 billion, which then basically I tell you who them continuously drop them, they're reducing the debt, which when you show it, so 3.85 billion from the financials from the share right here, so 3.8, well then run it up anyways, so 3.847 billion, but as I say, as I write right now, it's 3.5 billion, so there is that. All right, anyways, they're saying essentially after the APO they will try to reduce it down to 2.7 billion, and if they get additional it will go to, and then these are the list of loans that they have outstanding. Yeah, I'll pull up my amortization schedule, but it didn't really got no value. So basically they have a loan, with a floating asset. So basically it just means that a asset they might use as it. Yeah, they're using an asset, so if you can't pay money, they can sell asset at 0.5% per annum over 4 years, which is cool, is okay, which is fine. Then here's to know that the remember saying that they have two parts. They have one trade student living, and they have the restoration part, and basically they also raised money to renovate renovate the Gerald Lalor Hall basically, and they got it from VM Wealth, and there is $2.7 billion over a course of 15 years. And this is the tricky part. So the interest rate is fixed at 11.5% for the first 6 months. Alright, cool. And thereafter a variable rate of 350 basis point above the weighted average rate applicable to the 6-month Jamaica Treasury bill tenure. Whatever the Treasury bill is, and Treasury bill is essentially the safest, like if you're doing investment, is the safest, basically the safest investment they can do, because they're assuming that government of a country is the safest investment they can make. Alright, so if the government treasury bill is this, so the government treasury bill right now is 10% right now, 10% per annum, you can get safe, you don't have to worry about the money. Alright, fine, 10%. But because of this clause, the interest rate that one choose to live in would pay back to Victoria Mutual would be 350 basis points above the weighted average of it. So probably some people still wonder what is basis point. Basis point essentially for every 100 basis point it go 1%. So say, as I say, the Jamaica Treasury bill is 10%, and then they have to pay 350 basis point. I mean, they have to pay extra 3.5%. So in total, they'll be paying 13.5% interest rate for the 6-month period, like every 6-month period. So every time the basis rate change, that's the variable. However, I think they said they got it changed, so there is that. So the short-term loan now that they took out, long and short, you can still read it. By that day, they basically paid off everything. They paid off everything September 30, 2023. So there was that. So now for dividends. They paid out a dividend on February 23rd at 13 cents, which was about, well, which was $53.9 million. Alright, we'll do calculation a little bit less, like 53.8 something. 53.9 million. Alright, and at this time they had 414 million shares on outstanding or so. So in here, so there is that. Essentially, rest of this is just yappering. But one thing that I want to say is important is that they say, oh, the proposed dividend policy director expects the company in the short and medium term to grow basically, and then they would anticipate paying a semi-annually, mean every 6 months, amount up to, not guaranteeing, but up to 90% of distributable net income to shareholders. Alright, and going further into this video, everything is optimistic. Basically, I assume the best case scenario. Alright, their deleveraging strategy Alright, so the mids, so we can read it. Basically, what they're saying is that they intend to pay between 1.5 to $2 billion of the APO money to reduce debt. So I already go through that. And the company expects the debt level to be between 2.2 if them get for upsize, and 2.7 if they do not. Alright, I'm gonna say this optimistic, so we're gonna use the 2.2 basically. So they're going to decrease their debt, and they're saying that they expect to have approximately 255 million to 420 million available, for distribute to shareholders via dividends. And as I say, the aim is to pay out 90%. Alright. Companies typically never do it. Even some of the best companies, even Trans, Jamaica, they don't necessarily pay out the maximum. One company must do that, Kairas. But yeah, they go close, but not most. I mean, no, them really, when I think them actually. Anyways, we're going to be Mr. and Mrs. Dolulu and assume that we're the best case possible. So what I have concocted is a debt versus dividend situation. Alright, so pre-IPO, them have 3.57 blah blah in debt, as did show up on the financials. So we assume, say, best case scenario, them get the money and then them get for upsize. So them now have $2.2 billion in debt. But let's do the calculation. So them say them pay out 50, so they say they pay out $53.9 million in shares at 13 cents per share. And what I did not say, is 414,500,000 shares basically did available at that time. So I'm doing the calculation. It's basically 2.8% each share what I did get. I'm gonna say best case scenario free up cash. Why is this not 420? Is because I already take, as you can see from Excel, I already multiply it by the 0.9, which is the maximum them say them the payout in the event them get all of what they want. I'm gonna take out for them money. So all the rest would be now for the shareholders. As you can see, this calculation is what would be the amount shareholders would get if we just drop it out a closer figure, if they would get each year basically. So 0.407, and all I did was essentially the amount of money that would be available a year time where we would have free up the 378,000, which is this, and then divided by the amount of shareholders that would be there as of right now, which would be the 928 million basically. And then this would amount to a dividend payout of 9.38% per annum, which would be right up at the top with the big dogs. Is me. So yeah, that essentially is the local concoction. And the thing with this is that participating in this APO is that, one, when it comes to debt, them have to pay it. It's like right here, so them have to pay it. If say if you're not paying money, I go sell the asset rate that get by them money. Because whenever liquidation is supposed to happen, companies like debt holders are one of the first set of person them get the money. We over here, so ordinary shareholders, we get the right for vote and dividends maybe, but that's it. But if debt, they have to pay them debt. Is me. And then up on dividend side, if the rest of them come and say, I will give them a thing. Basically, at the end of the day, that's as you can put it. So this is sure. So that is why them want to drop this and reduce them debt. And this now them can say, yeah, but we can have it in a reserve for sure equity. So they might pay out some, but don't look for that figure there. Because then probably share price increase as well. I just used the share price as of today, which is $4.34. This price was off the day, which was February 20 something. And yes, I'm gonna check, go back always them time there to see. So yeah, so this is sure, this part them have to pay this regardless, and no dividend them maybe can pay it, the birthday. But as I explained before, the storyline is that young, and most of the time them they use the money for essentially just build out the infrastructure. Then COVID happened, and then now them have a year where them still look money and them say, I will pay to shareholders. It can also be a rules just because them not come to the market, them do that. But as I say, give them till next year, see what go on, and then you can call out say a foolish system I do regardless. If them decide to then not pay the dip, then I rate it or something. Say, so that's my 3 cents. And that is it, guys. Thank you guys for watching. As I said, I'm sorry I'm late. I'm back now. I'm up on another video already. Planned and everything already. Just in case me catch sick again. However, we're active. So with that said, thank you for watching. And I'll catch you in the next video. So yeah. Peace. Bye bye guys.